US stock markets have been on a winning streak so far in 2024, and even more so since Donald Trump was elected as President of the United States yet again. Joining me today to discuss the impact of these developments on market is CIO John Gilchrist. So John, PSG Asset Management has for some time had the view that inflation might be higher for longer than generally expected. Now, Trump's campaign pledges have made a lot of headlines. How do these developments impact on our views at PSG Asset Management?
Thanks, Audrey. And yes, as you rightly say, we've had a view that inflation would be higher than the markets have assumed. The markets have sort of coalesced around the 2% long-term inflation outlook. We think that is way too optimistic. There's been a number of reasons going back for a number of years why we've had that view. And even back in late 2021 into 2022, we were very skeptical around the transitory nature of inflation. We thought it was going to be around for longer and reach higher levels, which turned out to be prescient. One of the reasons, or some of the reasons for that, have to do with the deep level work that we do at stock level, where we're seeing significant underinvestment in supply. And if supply doesn't come on board, specifically of commodities, including energy, that will be inflationary. There's also the infrastructure builds required not just in the US, but in a number of developed markets. The drive towards renewables, which is a huge investment, which will once again create demand for some of those commodities that I referred to earlier. And also things like friendshoring, the change in terms of supply chains from just in time to being far more robust. So we had this view that inflation was likely to be higher than the market was anticipating. And with the election of Trump, we think that is even a stronger view. If you have a look at his policies, ranging from immigration through to tariffs, through to tax cuts, moving from 21% down to 15%, significant fiscal deficits, all of these are inflationary in nature. Now, he has announced the Doge department under Elon Musk, but that, in terms of being able to reduce the inflation, we have to see what will actually be done in that area. And so overall, we continue to see inflationary pressures. And it's quite interesting if you have a look at the 10-year break-even inflation rate in the US based on the inflation-linked instruments and the 10-year nominal bond. That moved from about 2% in September up to 2.3% when Trump was elected. So clearly there is some concern around the inflationary nature of his policies.
John, PSG Asset Management is concerned about the future path of inflation, and yet equity markets seem somewhat oblivious to the problems in the future. So, of course, US markets have continued to rally, and along with that, we've still seen continued strong performances from the Mag 7 stocks. Yet PSG Asset Management doesn't hold any of those stocks, and some would call that foolhardy. So how do we think about investment into the Mag 7 stocks from a PSG Asset Management perspective?
I think in order to answer that question, we have to go back to our philosophy and our process. So many of the listeners would be very aware of our 3M process, where we look at moat management and, very importantly, margin of safety. So the value of the various instruments versus the price that you pay is incredibly important for us. When you have a look at our philosophy, we like to look in areas of the market that are unloved, that are out of favor, and within those areas we look for quality that the rest of the market has missed. Now, clearly, Mag 7 is not unloved, is not out of favor. So it's no surprise that we actually do not have exposure to the Mag 7 right now. That being said, we've invested in numerous other opportunities, whether it be Star Bulk Carriers or Jackson, that have delivered 4.5 to 7 times their return, the invested capital, over the period that we've held them. So those have done very, very well for us. When we have a look right now at the Mag 7, scale is a significant issue. So the combination is over $17 trillion. They're currently trading on an average price earnings of 39 times, meaning that their earnings are in excess of $440 billion. Now, to put that in context, and as I said, scale is important, that's more than the South African GDP predicted for 2024 at 7.4 trillion rand. So these are very, very big companies. And the assumption is that they're going to continue to grow at very high levels. That's the only reason that the 39 times price earnings is justified by the market. Our concerns are in a number of areas. Firstly, a lot of the run-up that we've seen has been driven by AI assumptions in terms of what it's going to mean for the world, and most importantly, the return on investment from the significant AI investments that these Mag 7 companies have made. Now, we haven't seen indications that there is going to be the sort of return on investment that is required to justify the large-scale investment that they've made. The other area is the fact that from an accounting perspective, and sorry to go into the technicalities, but it is important, is every dollar that is spent by a Mag 7 company on a NVIDIA chip boosts earnings for the entire Mag 7. And that's because that revenue that NVIDIA generates by selling the chip drops straight down to their bottom line, so straight into their earnings. And those companies within the Mag 7, for example, that are buying those chips depreciate them over a period of time. So the cost doesn't come into their earnings and the full benefit from NVIDIA comes through. And it's similar to what we saw in the late 90s. Earnings can be boosted by this for a substantial period of time.
So, John, I think one of the results of the immense run-up that we've seen is enhanced concentration in indices. Now, what does that mean for investors, and should they be concerned?
Yeah, so if we have a look at the S&P 500, which, as you say, has had an incredibly strong year and number of years, within that, the Mag 7 is close to a third of that index. When you have a look at the MSCI World, the US is over 70% of that index. So from a global investing perspective, you really have got a lot of concentration into those Mag 7, which I mentioned are trading at a sort of average current price earnings of nearly 39 times. So you've got a lot of concentration, which is generally not good for subsequent equity returns. What's also quite interesting is having a look at the relationship historically between price earnings and subsequent returns. And if you have a look at Shiller's data, for example, just having a look historically, as I said, this is not a forecast, but at a sort of price earnings for the S&P 500 as a whole of over 26 times, remember 39 times for the Mag 7, the rest of the index trading quite a lot cheaper. From that sort of 26 times price earnings, the average historical 10-year return would have been negative from that position. So going forward, it is a challenge in terms of not just US markets, but because of their size within global markets, as to whether we're going to be able to see good, solid, real returns from these indices going forward.
So, John, if there's one thing we know about markets, it's that they will surprise us. So as we look ahead into 2025, where are you finding opportunities, and how does that factor into your portfolio positioning?
So not surprisingly, given what I just said, we have a significantly lower exposure in the US relative to a lot of our competitors and sort of strategic asset allocation for our competitor funds. And so we underweight both equities and US bonds. I talked about inflation, so not surprisingly, we are cautious on the US bonds, even though they've sold off since September from 3.6% on the 10-year US yield out to 4.4%. We still don't necessarily see huge value at that sort of level, seeing fair value above 5. So we underweight the US. We're picking up a lot of exposure selectively using our 3M process in the UK, in Japan, in Europe selectively, and also in certain emerging markets. So we saw Chinese stocks sell off very aggressively. We picked up some shares in Hong Kong, and we're looking at other emerging markets as well, including Brazil. In terms of South Africa, even though our bonds have rallied strongly, we still see lots of value in that space. So we've got lots of SA bond exposure and SA Inc. exposure. Once again, that has bounced subsequent to the formation of the Government of National Unity, but we expect earnings to come through with base effects from load shedding, with lower interest rates, and with higher consumer and business confidence. We do expect those earnings to come through, which should drive those share prices. So positive on SA bonds and SA Inc. We're also still positive in terms of commodities, very select. I mentioned the undersupply of certain commodities, and that underpins our theses in those areas. So energy and select commodities like platinum and copper. copper in particular because of the significant demand we believe is going to come through the renewables, and a misunderstanding as to how prevalent EVs are going to be globally. Then in terms of portfolio construction and also fundamentally, we have strong positions in gold. And then you mentioned the uncertainty going forward. We've seen the volatility index actually stay very, very muted despite the significant geopolitical issues that are happening globally. And so we've got good hedging in our portfolios in the form of put options, which should give us that stability, even if the world turns out to be, as you mentioned, incredibly unpredictable and events coming from left field. So overall, we believe we've got robust portfolios that should deliver well for our clients, even in a tough environment, as is indicated by the levels at which global indices are trading.
John, thank you so much for joining me today and taking us through the impact of Trump's election on markets going forward.
Thanks very much, Audrey.